Hey small business owners, today I'm going to be talking about perhaps the most relevant topic following the Tax Cuts and Jobs Act of 2017, and that's the Qualified Business Income Deduction, or as it's sometimes referred to, the 20% pass-through deduction. At the high level, the deduction allows you to reduce your qualified income by 20% before calculating tax, but as with anything related to tax, there's a lot of nuance. The biggest factor that are considered are your taxable income at the individual level and what activities your business is engaged in. So let's get into it. In order to qualify for a qualified business income deduction, one must have qualified business income. Qualified business income is basically just the net taxable income of your pass-through business, taking into account items of income and gain reduced by deductions and loss. This income can come to you on your Schedule C sole prop, potentially your Schedule E, your rental income, your S Corp K1, or your partnership K1. Keep in mind, income as an employee does not count as qualified business income, even if your W-2 is coming from the same business that your qualifying K1 is coming from. Specified service trades or business are also excluded, though at lower income levels, SSTBs may also qualify. I'll be defining SSTB a little more in part 3, but if you're an accountant, attorney, doctor, consultant, athlete, and the like, that means you. For individuals whose taxable income is under defined thresholds, the deduction is straightforward in that your pass-through income will qualify for the full deduction irrespective of other quantitative criteria, which I'll get into later. For 2019, this lower threshold for taxpayers filing single or head of household is $160,700. If you're married filing separate, then you have a lower threshold of $160,725, and married filing joint, you have a lower threshold of $321,400. Once you exceed the lower taxable income threshold, you have a phase-in of additional criteria you'll have to follow in order to maximize the deduction. And if you're in a specified service trade or business, you begin to phase yourself out of the deduction completely. If your taxable income, again, this is at the individual level, exceeds the upper income threshold and you are not in an SSTB, you can still qualify for the full deduction, but you have to pay W-2 wages and or invest in qualifying business property. I'll go into more detail in part 2. If you happen to be in an SSTB and your taxable income is above the threshold, you don't get the deduction. Though, there are some planning opportunities that we can employ in order to still get you some or all of the deduction. I'll go into that in more detail in part 3. Hey everybody, thank you so much for watching our video. If your business is in the greater Orange County or Los Angeles areas and you're looking for a tax and accounting firm that truly understands small to medium-sized businesses, please give our office a call. Otherwise, if you just like our content, please like, share, subscribe, or comment. Thanks again and have a profitable day.